Hello, everyone. Welcome to the fourth episode of Outsourced CFO's most common gap analysis risks. As a company, we've performed gap analysis for financial gap analysis for many companies over the years. And what we've realized is that the same issues keep popping up. So we're doing this video series to make you aware of some of these things, and maybe you can resolve them on your own or speak to your accountants so that they don't keep popping up. My name is Uwais Asmal, and I'm the head of advisory services at Outsourced CFO. Jumping into the first thing that I want to talk about is key management. Entrepreneurs, as we know, are brilliant. They are visionary, but some lack the financial insight and expertise to take the financial decisions that will grow the business. Yes, you bring the ideas, and if you don't have that, that's fine. Hire someone or outsource it, but you need to have that strategic level of financial thinking to help grow and scale your business. Sometimes the business also relies too much on key individuals. And if something happened to those key individuals, the business would end. That same applies to lack of succession planning. Sometimes management is too involved in the day-to-day operating the business and are not involved in growing the business. The old adage of you should be working on your business and not in your business. Sometimes also directors or senior management interests are not aligned. And that just could be because incentive structure is not properly designed so that the interests are aligned for the business to grow and for you to benefit. Moving on to the next topic is costs. Unnecessary costs in certain areas. Small things, for example, like having your bank account with the wrong bank and paying excess costs, or having the wrong bank structure and paying excess costs, or saving all your money in a current account and wasting, not earning interest on that money if you're sitting on cash. Also, having no budget in place means you don't know if you're spending too much or too little. Also, if you don't have an accountant, you might be calculating the wrong tax and paying the wrong tax, not using assessed losses or not being a small business. But we'll talk a little bit about that in another episode as well. Loans. This can be a big problem for small business owners. Loans are issued to related parties or even to yourself, but without proper terms and with no interest rates. The big risk for that is that SARS could deem it to be a deemed dividend, and because no dividends tax was paid on it, SARS is going to charge you penalties and interest. That's a big risk. As businesses start growing, sometimes entrepreneurs start opening different companies, and then they start making loans between these companies. But what they don't do is they don't have an intergroup loan matrix where they tie in all those loans. So the loan could be sitting at 100,000 in one business and 50,000 in another business, and it's not matching. That's also a big problem that comes up quite a bit. Another thing that happens is also with giving loans to different parties or to different businesses, some of those loans are actually not recoverable, and that's a big issue. Also, some businesses are highly geared and have far too much debt, and there's no process in place or no plan in place to reduce that debt or to pay down that loans, and you need to sort that out. Another issue is loans classified as long-term that should actually be short-term because they could be settled. The loaner could pitch up at any stage and say, I need my money now, in which case it should be a current liability. That's it for this week. Stay tuned for the next episode. Thanks very much.
Hey, Lau here, one of the founders of Outsourced CFO. If you enjoyed this video, make it official. Click subscribe.